What are the most important mistakes to avoid in order to set yourself up for a bright future with retirement?
I watch. Failure is not an option.
Well, welcome back to the Parkmount Financial Partners YouTube page. We are going to be talking about just that today. Retirement for most folks is going to be the most expensive thing that they purchase with their money over the course of their life. Purchasing financial independence for perhaps a number of decades is not a small feat, and preparing and thinking through all the angles is essential. Even a small mistake can have a pretty significant impact over the course of a number of years. So we're going to be starting to think about some of the areas that we want to be double checking and often see people having missteps on. And so let's get into it. The first and most common mistake is not understanding inflation. If someone retires at 62, there's a 10 to 20% chance that they are going to live past 92. That's a 30-year period. It's 3 decades. And over the course of that time, if we project just trendline inflation, their cost of living, even if they don't increase it at all, is going to more than double. So going into retirement with a plan, not just to maintain income over that 30-year period, but also to have a plan in place to increase your income steadily such that you can double it throughout those 30 years is critical. And if you don't have a plan for that, you might just be planning to run out of money. And so that is the first mistake and most common mistake that we see for people planning to retire in the near future. The second one is overspending throughout someone's career life. They could be good savers, but they're not thinking about how much they're saving, how much they're spending. They just develop this autopilot that seems to work with them. As they go into retirement, they're not going to be able to produce income as easily as they did while they were working. And so having a strategy and living off of a nest egg requires a lot of thought and planning and monitoring in order to ensure you're doing it effectively and not deviating off course, which you might not even get feedback on until it's years down the road and too late. The third major mistake is not accounting for health-related factors. There's been a lot of research out there, and it's pretty reliably established that someone heading into retirement will probably need to spend, even if they're on Medicare throughout their retirement, an additional $100,000 to $200,000 throughout their retirement years for co-payments, additional costs that come up, extra premiums, and so forth. And that's an average. It could be lower, it could be lesser. And then in addition to that, long-term care is another factor to consider for later on down the road in retirement, which can be incredibly costly if you don't have an insurance plan, you don't have some other plan for long-term care. That is a cost that you are going to want to think about and plan for in your retirement strategy. And so if we add all these together, it's not unlikely to think that someone might misestimate the amount that they need to retire comfortably by several $100,000 if they haven't factored into their plan these health-related cost factors. And fourth is just not understanding the risk reward trade-off. As people get into retirement, they're often heavily biased against risk in the stock market, and not without reason. There is certainly a lot of historic volatility in the stock market, a lot of things to be aware, and taking risk without appropriate cautionary measures could also be a significant mistake in retirement. It's been more common that I see people approaching their retirement investment strategy by not wanting to take enough risk. If we take periods over a 30-year period, just comparing stocks to bonds, bonds being the more conservative investment vehicle, generated an average return of about 6%. If we look since World War II, stocks have generated on average approximately 10%. And so as you think about that, you might say, well, why would I take this risk in the stock market? It could go down by 40, 50% in 1 year when I have these bonds. Well, the fact of the matter is that if we look at the difference net of inflation, the bond portfolio, net of 3% inflation over that roughly the same time period, is only generating 3% per year. And the stock portfolio is generating in excess of inflation over 7% per year. So when we, that might not sound like a big difference in one given year, but if we take that over a longer period of time, 10, 15, 20 years, maybe even longer, the difference becomes pretty dramatic. Standard retirement portfolio and bonds to stocks over that time period, maybe an ending value difference of millions of dollars. And so it's important to understand that it may be entirely reasonable to have a good chunk of your portfolio, if not most of your portfolio, invested in the stock market throughout your retirement years, even as we experience a number of bear markets and pullbacks throughout those years. Planning, of course, to make sure you're not overly exposed to the stock market and that you have appropriate measures against some of the volatility is equally critical. And so it's important to have an individualized plan that accounts for all these different factors. The fifth common mistake for retirees, people going into retirement, is not diversifying enough. Putting aside individual stocks, one of the most common things that I've seen lately on Reddit is people going in and saying, oh, what should I invest in? And someone will say, oh, you invest in the QQQ, the NASDAQ, it's been doing fantastic. Or the most common response is just invest in the S&P 500 and forget about it. While these vehicles are sound and have had historic success, it's not historically balanced way to approach it. If you actually look at history, there is quite a frequent rotation between international stocks and U.S. stocks to outperforming each other. A diversified portfolio will have both international stocks and U.S. stocks. And while some U.S. companies do get a lot of revenue from overseas, the impact of having a globally diversified portfolio is pretty significant. In fact, in the period from around 2000 to 2010, if you had a diversified portfolio, you would have been up. If you had been only invested in the U.S. Stock leadership, you actually would have had basically a lost decade, a whole 10 years of flat performance. And so having a globally diversified portfolio is important. And having small cap stocks could be a valuable part of your diversified retirement equity portfolio. And the reasoning behind that is that over long periods of time, there's data that shows smaller companies actually outperform larger companies when looking at history. And so making sure that you have a portfolio that's not just doing what's been doing great, the past 5 or 10 years, but also historically looking on a longer perspective over multiple decades and different cycles throughout a longer part of history, having a portfolio that is positioned well with that big picture in mind and not just what's been hot lately. So I hope you found this helpful. Again, my name is Joe Bogan. I'm a certified financial planner at Parkmount Financial. We specialize in working with people, planning for retirement and then into retirement, helping them to and have the support of a professional to help them with their distributions and tax efficiency and investments and all of that. If you found this interesting, go to our website. We have got a free copy of our client newsletter available. If you put your email address, we'll send you that. Thanks, and until next time.